Most people believe the economic ladder is a game of effort. You study hard, you get a decent job, you climb the corporate ladder, and eventually you retire comfortable. It's a clean, linear, comforting narrative. But there's a quiet, frustrating realization that hits almost every middle class professional around the age of 30 or 40. You look at your bank account, you look at your mounting responsibilities, and you realize you did everything right. You followed the manual perfectly, yet you are still one major medical emergency or one corporate downsizing away from absolute financial panic. Why? Because the economic system we live in is not broken. It's working exactly as designed. The uncomfortable truth is that the middle class is operating on an entirely different set of rules than the truly wealthy. The rules you were taught: save 10% of your income, buy a house as your biggest asset, avoid all forms of debt, and trust the stock market to give you an average 8% return over 40 years are not rules designed to make you rich. They are rules designed to keep you compliant, predictable, and taxable. The wealthy do not play this game. They play a game governed by an unwritten, counterintuitive set of laws that are actively hidden in plain sight. Secrets that are not taught in schools because the institutions that build the curriculum rely on your labor to fund their systems. In this video, we are going to tear down the illusion. We are going to break down the four hidden rules of wealth that the middle class constantly ignores. Rules regarding velocity, structural asymmetry, cognitive decoupling, and the dark reality of leverage. If you feel like you are running as fast as you can on a treadmill that keeps speeding up, this is exactly why. And the first rule we need to shatter is everything you have ever been told about the safety of saving money. Rule 1: Velocity over accumulation. Let's start with a foundational psychological trap: the obsession with saving. From the time you are a child, you are given a piggy bank. You are told that the smartest thing you can do with money is to put it away for a rainy day. When you grow up, this manifests as a high yield savings account or a conservative mutual fund. The middle class views money as a pool, a resource to be collected, dammed up, and protected. Success is measured by the depth of the pool. The wealthy view money entirely differently. They don't see it as a pool, they see it as a river. They understand the law of economic velocity. Money is not an intrinsic store of value, it is a medium of exchange, it is a tool for energy transmission. The moment money sits still, it begins to die in an inflationary environment. A stagnant pool of cash is actively evaporating. Even if your bank gives you a 4% interest rate, if the real world cost of living, housing, healthcare, education is rising at 7% or 8%, your stagnant pool is shrinking in purchasing power every single second. The wealthy do not accumulate money to hold it. They accumulate money to immediately convert it into velocity. Think of it like this: if a middle class person makes $10,000, they might save $2,000 in a bank account. That $2,000 sits dormant. It does nothing for the economy, and it does nothing for them except provide a false sense of security. When a wealthy individual or entity handles that same $10,000, they immediately look for a way to pass it through an asset class that forces it to move. They use it as a down payment on a property. They reinvest it into automated marketing for their business, or they fund a contract that yields an immediate recurring return. They understand that wealth is generated by the speed at which money moves through productive assets, not the sheer volume of cash sitting in a vault. The faster a dollar completes a cycle, moving from your hands into an asset, generating a return, and coming back to you to be reinvested again, the wealthier you become. The middle class trades their finite time for stationary cash. The wealthy trade stationary cash for expanding assets that buy back their time. But to understand how they do this without losing everything, you have to understand the second hidden rule, a concept that explains why the rich seems to get bailed out or profit during economic crashes. While the middle class loses their home and livelihoods, it comes down to a structural design feature of the modern economy that almost nobody talks about. Rule 2: Playing a different legal and tax game. If you are an employee earning a traditional salary, You are playing the game of economics on the highest difficulty setting imaginable. Let's look at the basic math of a middle class paycheck. You work for a month before a single rupee or dollar hits your bank account. The government takes its cut via automated payroll taxes. You receive the net amount, the leftovers from the net amount. You pay your rent or mortgage, your groceries, your car payments, and your utilities. Finally, if there is anything left over at the bottom, you spend it or try to save it. Your financial flow is linear. Earn, then tax, then you spend. The wealthy operate under a completely different corporate and legal framework. They do not earn money as individuals. They earn money through legal entities, corporations, trusts, and limited liability structures. This is not just a fancy way of organizing business. It completely flips the sequence of how money is handled. A corporate entity earns revenue. It then spends that revenue on everything required to operate, expand, and sustain itself. Travel, vehicles, equipments, technology, dinner with clients, and operational costs. Then, and only then, is the company taxed on whether profit is left over at the very bottom. Their financial flow is cyclical. They spend, then they are taxed. This is what we call structural asymmetry. The middle class pays taxes on their gross income before they even feed their families. The wealthy pay taxes only on their net profit after they have already funded their lifestyle and business operations through the entity. But it goes deeper than just tax write offs. It extends to how the system handles risk. When a middle class individual takes out a loan, say for a house or a car, they are personally liable. If they lose their job and cannot pay, the bank comes for their personal assets. Their credit score is ruined, their savings are seized, and their life is upended. When a wealthy individual wants to execute a business venture, they use institutional capital insulated by a corporate shield. If the business venture fails, the corporation filed for bankruptcy. The individual's personal mansion, private accounts, and generational wealth remain completely untouched behind a firewall of legal protection. The system is designed to reward risk taking at the macro level while punishing vulnerability at the micro level. The middle class takes a maximum personal risk for minimal linear reward, while the wealthy take on calculated institutional risk for exponential asymmetric reward. But how do you even begin to acquire the types of assets that allow you to play this game? It requires shifting a mental model that has been deeply ingrained in us since childhood. It requires what psychologists call cognitive decoupling, separating your income from your physical presence. Rule 3, cognitive decoupling. Let's perform a quick mental audit. If you stop working tomorrow, how long do you survive financially? For the vast majority of the middle class, even high earning doctors, lawyers, and software engineers, the answer is a few months, maybe a year at best. Why? Because they are caught in the time value illusion. They believe that the path to wealth is increasing the value of their hourly rate. If you make $20 an hour, you think success is making $50 an hour. If you make $100 an hour, you think success is making $300 an hour. But the fundamental flaw remains. You are still trading a non-renewable, finite resource, your time, for a renewable, depreciating resource, money. There are only 24 hours in a day. Even if your hourly rate is astronomical, your wealth potential is hard capped by the laws of physics and human endurance. You cannot scale yourself. The wealthy have decoupled their income from their time entirely. They do not sell their labor. They build, buy, and own systems that manufacture value automatically. Consider the anatomy of a business. A business is nothing more than a structured system that solves a recurring problem for a specific group of people at scale. Once that system is built, refined, and staffed with competent operators, it no longer requires the physical presence of the founder to generate revenue. The founder can be asleep, traveling, or working on another project, and the system continues to process transactions, fulfill orders, and collect capital. The middle class focuses on being a component inside the machine. The wealthy focuses on owning the architecture of the machine itself. This applies to investments as well. The middle class invests passively, often throwing money into an index fund and hoping the macroeconomy stays stable for 40 years. The wealthy invest actively for control and cash flow. They buy real estate not just because the price might go up, but because tenants pay down the debt every single month while providing immediate tax shelter. They buy equity in private companies where they can influence the direction of the business and accelerate growth. If your income requires your physical presence, your intelligence, and your daily effort to exist, You do not own wealth, you own a high paying job. True wealth begins the exact moment your asset generate enough cash flow to cover your lifestyle expenses without you lifting a finger. It is the transition from a linear income to an exponential decoupled income. But to build these machines, to buy these cash flowing assets, you need fuel. And the fuel used by the wealthy is the exact thing that the middle class is terrified of: depth. Rule 4: good debt versus bad debt. If you ask the average middle class person about debt, they will tell you it is evil. They have read the personal finance books that tell them to cut up their credit cards, pay off their mortgages as fast as possible, and live a completely debt free life. And for the middle class, this is actually good advice. Why? Because the middle class uses consumer debt. Consumer debt is borrowing money from the future to buy something that loses value today. It's using a credit card to buy clothes, taking out a high interest loan to buy a sports car, or financing a vacation. This type of debt is a financial anchor. It drains your monthly cash flow, charges you predatory interest rates, and forces you to work harder just to pay back what you have already consumed. The wealthy do not use debt to consume. They use debt as a financial weapon. They use production debt. Production debt is borrowing money at a low interest rate to purchase an asset that yields a higher return than the cost of the debt itself. This is the concept of leverage. Imagine you have $1 lakh in cash. As a middle class investor, you might take that $1 lakh and buy a single piece of property outright. Now you have no debt, which feels safe. You collect $1,000 a month in rent. Your return is stable but linear. A wealthy investor takes that same $1 lakh and does not buy one property. They use it as a 20% down payment to buy a $5 lakh apartment building, borrowing the other $4 lakh from a bank at a 5% interest rate. The apartment building generates $5,000 a month in rent. After paying the bank's mortgage, insurance, and maintenance, they are left with $2,000 a month in pure profit. But here is where the hidden rule completely changes the game. They did not just double their monthly cash flow compared to the debt free investor. They now control a $5 lakh asset instead of a $1 lakh asset. When that real estate market appreciates by 5% over the year, the debt-free investor's property gains $5,000 in value. The wealthy investor leveraged property gains $25,000 in value. The wealthy investor used the bank's money to multiply their wealth creation by 5 times, while using the tenant's money to pay off the bank. Furthermore, under modern tax laws, debt is not considered taxable income. When a multimillionaire needs cash, they don't sell their stocks or their real estate, because doing so would trigger a massive capital gains tax. Instead, they take their massive portfolio of assets to a bank and take out a low interest loan against those assets. They get millions of dollars in tax free cash to spend or reinvest, while their underlying assets continue to grow unhindered. The middle class work hard to pay off their debt. The wealthy use debt to make sure they never have to work hard again. Escaping the trap. Conclusion: escaping the middle class trap is not about working 16 hours a day at your current job. It is not about skipping your morning coffee or clipping coupons to save an extra few pennies. It requires a fundamental rewiring of your economic philosophy. You must stop viewing money as something to hold on to out of fear and start viewing it as an instrument of velocity. You must transition away from earning income as an isolated individual and start utilizing legal structures that offer asymmetry. You must deliberately decouple your time from your revenue by building or buying into scalable systems. And finally, you must learn to view calculated leverage not as a danger, but as the primary accelerator of generational wealth. The matrix of the middle class is comfortable, predictable, and heavily reinforced by society. But once you see the hidden rules of the game, you can never unsee them. The question is not whether the system is fair. The question is, which set of rules are you going to play by from this day forward? If this breakdown opened your eyes, hit that subscribe button. Leave a comment below with the rules that surprised you the most, and share this with someone who is tired of running on the financial treadmill. We will see you in the next video.